There are moments when nothing dramatic happens. Markets remain calm, and yet the rules underneath the system begin to shift. Today's money signal comes from one of those moments. What initially looks like a bureaucratic decision in Washington, a diplomatic reaction in Brussels, and a market comment buried in the business pages, together point to growing strategic friction between the European Union and the United States. Government, not over tariffs or energy, but over who sets the rules of the digital economy. Washington uses visa policy as a regulatory signal. According to reporting by Business Insider, the United States has imposed visa restrictions on several European digital policy officials and former regulators. US authorities argue that European technology laws, particularly the Digital Services Act and the Digital Markets Act, are being enforced in ways that extend beyond Europe's borders and place disproportionate pressure on US-based technology companies. Briefings from the US State Department frame the move as a response to what Washington views as extraterritorial regulatory reach. The message is subtle but clear. Regulatory decisions made in Europe are increasingly shaping global business conditions for American firms. For consumers and investors, this matters because higher legal and compliance costs rarely stay inside corporate balance sheets. They tend to surface gradually in the form of more expensive digital services and higher regulatory risk for tech-heavy investments. Europe rejects the move and signals regulatory firmness. European officials responded quickly. As reported by The Guardian, the European Commission formally condemned the US decision, rejecting the accusation and signaling that potential countermeasures are under review. Statements from Brussels indicate that enforcement of existing digital rules affecting US firms operating in Europe could tighten, and that regulatory cooperation with Washington may be reassessed. European officials stress that this is about defending regulatory sovereignty, not escalation. Still, the tone marks a shift. What had largely been handled through coordination and dialogue now carries elements of reciprocal pressure. For households and businesses, tighter enforcement can translate into slower product rollouts, fewer platform choices, and reduced competitive pressure, conditions that typically lead to higher prices over time, even if no new regulation is announced. Markets quietly price uncertainty, not politics. While political rhetoric unfolds, markets are focused on costs. Reporting by the Washington Post highlights growing concern among industry groups and analysts about regulatory uncertainty for cross-border digital services, cloud computing, digital advertising, artificial intelligence, and data-driven platforms that depend on seamless EU-US data flows are seen as particularly exposed. Several multinational firms have reportedly delayed long-term digital investment decisions, not because rules have already changed, but because future alignment between Europe and the United States has become less predictable. For consumers, this shows up slowly through higher subscription prices, more expensive advertising tools for small businesses, and rising costs for cloud-based services. For savers, it can mean indirect pressure on pension funds and retirement accounts with heavy exposure to large technology companies. Taken on their own, these are separate stories reported by different outlets. Taken together, they form a single signal. This is strategic friction over rule-setting power in the digital economy. Instead of tariffs or sanctions, regulatory frameworks themselves are becoming economic levers, shaping capital allocation, investment decisions, and long-term competitiveness between Europe and the United States. Nothing breaks suddenly. No markets panic. But costs rise, uncertainty spreads, and money quietly adjusts. This is not a warning, it is a signal.